Can you hear me? Yeah, okay. And also our online speaker, can you hear me? Yes? Okay, perfect. So good afternoon, everyone, and welcome back to Bruegel's annual meeting for a session on monetary and macroeconomic policies at the crossroads. My name is Gregory Kless. I'm a senior fellow at Bruegel, and I'll be moderating the discussion today. So today's discussion is going to be about macro policies. It was supposed to be after COVID, but now it's also macro policing during COVID, given of the Delta variant. So the session is very timely because a quick reopening of the economy in many countries is resulting in both pent-up demand and supply bottlenecks, which combined with a strong base effect, increased energy prices and a very stimulative policy mix have led to a quick rise in inflation in many countries this year. This is particularly true in the US, where headline inflation based on the CPI reached 5% year-on-year in June and July 2021. And it was the first time it did so since 2008. The situation is a bit less acute in Europe, where the recovery is a bit lagging the one from the US. And in the euro area, nevertheless, inflation has reached 3% in August, which is the first time it does so since 2011. At this stage, it's still very early to know if this is a temporary phenomenon following a very peculiar recession, or if we are witnessing a regime shift after decades of low inflation due to profound change in macroeconomic policies with more active fiscal policy and possibly a different, less independent central bank, or even the risk of fiscal dominance. And also, this could also be due to a different economic structure, which could come from demography or from a different power dynamics between labor and capital. So the debate at this moment on whether this inflation is a temporary phenomenon or a more lasting one is raging. And actually, some of our speakers today have been on different sides of that debate. Which is an important debate because the policies that we put in place depend on whether this is a temporary or a lasting phenomenon. So this is what we want to discuss today. And to discuss this crucial issue, I'm delighted to have 4 amazing speakers that will be able to reflect on this topic from different perspectives. They don't need much introduction, but let me introduce them quickly nevertheless. So joining online from the US, we have Gita Gopinath. So Gita is the chief economist at the International Monetary Fund, and she is on leave from Harvard University, where she is a professor of economics. Welcome, Gita. We have Larry Summers. Larry Summers is also a professor at Harvard University, but also President Emeritus of Harvard University, and he has been involved in policy in the last 3 decades as a Treasury Secretary during the Clinton administration and as Director of the National Economic Council during Obama's administration. And then with me in Brussels, I have also the pleasure to host Per Carlsen, who is the governor of the Danish Central Bank since 2011, and before that, he was working at the Ministry of Finance of Denmark and at the IMF. And last but not least, I have the pleasure to also Jorge Sicilia, who is the chief economist of the Spanish banking group BBVA, or BBVA in English, and the head of the BBVA research group. Let me thank all of you very much on behalf of Bruegel for taking the time to participate in this event, and for those of you who are present in Bruegel for making the adventure to take the plane in such a difficult period. Before I give the floor to our speakers, let me quickly explain how we will proceed in this session. So we'll first start with 2 keynote speeches from Gita Gopinath and Larry Summers, who will each have 15 minutes. And then this will be followed by a panel discussion with our 4 speakers, in which we will also take questions from the audience. For our audience, both the online audience and our audience here present that we are really happy to see in real life, questions need to be asked through the internet, through a website called Slido that you can reach just by writing sly.do or slido.com, both work. Or also directly on the web page of the event on Bruegel's website, using the code hashtag BAM21 monetary. So please, you can put your questions there, and I'll be able to read them on my tablet later. So without much further ado, let me first give the floor to Gita. Gita, thanks very much for joining. The floor is yours.
Thank you, Gregory. It's a pleasure to join this panel. And I could not hear you at the start, so I'm sure you said very important things that I missed. Forgive me for that. Let me, I have a short presentation, so I'm going to share my screen and go over a few slides. Okay, I think you can see that, and let's just put it on full screen mode. Okay, so we're talking about monetary and macroeconomic policies at the crossroads, and I thought I would spend my time on first starting out with the consequences of the exceptional large monetary and fiscal support that was provided and that continues to be provided in advanced economies, and the consequences of that and what that implies in terms of next steps for policy. I will spend most of my time on that particular issue, but then I also want to touch a little bit on the labor market recovery, the unevenness of the recovery, and on climate mitigation and having sustainable growth. So let's just jump in. So this is my first slide here, which makes the point that after a decade of being disillusioned with inadequate fiscal policy support, these last 18 months have been a period of highly unprecedented joint monetary and fiscal support in response to the pandemic. And that was a good thing, that was needed. This was a crisis like no other, and there were areas that monetary policy simply could not fix, with countries being put in lockdowns to protect the health of the community. So when you see on the left graph here, you can see that you're looking at current monetary policy rates, and it tells you the fraction of countries whose policy rates are at record lows. And if you look at advanced economies, that's the red bar, that's around 80%. And as we know, Korea was the first advanced economy to start raising rates. And that's true, by the way, also for emerging markets. We're talking about 60% that have currently record low policy rates, though there is movement happening now with some countries raising rates. The middle graph shows you a comparison with the global financial crisis period. It looks at the amount of fiscal support, and here by this we are looking at above the line measures, which are revenue and spending measures, and comparing that to how much these countries did right after the GFC. And you can see these are many multiples of what was done. The US, for instance, is kind of 5 times larger than what it did after the GFC. So this time around, there can't be complaints that there was not enough done on the fiscal policies front. And then the right graph tells you about the pretty close interaction that comes about in circumstances like this of the interaction between fiscal and monetary policy. So there's been large-scale asset purchases, programs that have been rolled out. It was essential in the beginning of the crisis when there was market dysfunction that could have then led to a financial crisis of the world, which it did not happen, despite having one of the most severe recessions since the Great Depression. And so, that was absolutely essential too. And what the right graph is basically showing you is that as a part of the asset purchases, a significant amount of new issuances by governments, the new debt that they put on the market, was basically being bought by central banks, the major central banks. And actually, for the first time, that's what the red bar shows you, is that for the first time, you actually had emerging markets also do quantitative easing. As I guess this is the lesson learned from a decade of what unconventional monetary policies can do. Countries also, many more countries with interest rates pretty close to the zero lower bound. And being able to use some of the reputation they had built up in terms of sound monetary policy making, being able to deploy that in times of a crisis using unconventional measures. So again, very strong support was provided. And what has that done? What did that do? Our estimates is that these was crucial in helping limit output losses. For instance, our estimate of in the absence of these kinds of measures, we estimate that the global recession last year would have been 3 times as large. And so these policies played a very important role. And on the left graph, what you see here is the path of recovery that we've seen so far in the US and in the euro area, and our projections going on till the end of next year. And what you can see is the rebound coming back. The US has already surpassed, kind of crossed pre-pandemic levels, or just past pre-pandemic levels, and is on course to even cross the level it would have been projected to have in the absence of the pandemic, which is if you compare the solid blue line to the dashed line. And in the euro area too, you've had a strong recovery. It's coming with a lag for multiple reasons. But again, by the end of this year, the euro area is expected to also return back to pre-pandemic levels and close the gap with the pre-pandemic path. And this is very important to keep in mind, because if you contrast this to after the GFC, this 2 years after, 18 months after the GFC, we were staring at very big gaps that had to be closed. And if you look at the projections, which is the right graph in terms of the medium-term projected per capita income losses, we are looking at, for the advanced economies as a whole, effectively no scarring. The euro area also, we're looking at very low numbers. There is, of course, heterogeneity within the region. And the US, where there is a big positive in terms of per capita gain, which, by the way, this is based on our projections, assuming that these packages in terms of the jobs plan and the infrastructure plan and the new incarnations of it go through and actually get done. Another point I just want to flag to, which is you can see on the right graph too, is the much greater scarring that's predicted for emerging and developing economies, excluding China. Again, a novel phenomenon relative to after the GFC, when it was the other way around, which was the scarring was in advanced economies and not in emerging and developing economies. But again, an important difference, which is emerging, if you look at emerging Europe, that is not where we have the projections for greater scarring. Emerging Europe has done, in relative advanced Europe is in terms of the severity of the recession, has done somewhat better. And so again, this contrast of emerging and developing economies having larger scarring than advanced economies kind of excludes the emerging Europe region. Okay, so we are now here. There's good news is that countries are doing well in terms of the recovery. The pandemic, of course, is not over. And we have a new problem that had disappeared for the last decade, which is the concern that maybe all of this has been a bit too much and has triggered, inflation of the kind that we haven't seen before, and importantly, that this could then somehow spiral out of control in advanced economies. And those are kinds of arguments you have typically for developing countries where there are problems of credibility of central bankers. But this has become a topic of concern also for for advanced economies at this point. So what do we see here? So I said two pictures. The left graph is basically showing you the relationship between, where the countries in which inflation has surprised strongly on the upside relative to their pre-pandemic trends levels, contrasting that with where their growth has surprised strongly, and not necessarily surprised, but has come in strongly on the upside relative to their pre-pandemic growth rates, right? And what this picture shows you, it's not a perfect fit for sure, but what it tells you is that it's in parts of the world, in countries where the recoveries have come back the fastest, where you are seeing these kinds of inflationary pressure. So where the gaps are being closed the fastest, that's kind of where you are seeing these inflationary pressures. So you might expect that with demand coming back very strongly, but with supply constraints still being there, that this is an issue. Now, what the right graph tells you, which is one important statistic of many for trying to understand how persistent you expect these inflationary changes to be, is inflation expectations. And here, again, so far, we have seen very little that suggests, at least when it comes to long-run inflation expectations, the near term has moved, but there are good reasons for that happening. But if you start looking out, just 5 to 10 years out, we look at, there hasn't been much movement in those inflation expectations in line with what you would expect as long as policy frameworks remain credible. Now, again, what I want to tell you in terms of the whole inflation debate is that obviously it's not one story for the world, for the advanced economies, even within the advanced economies. So again, here's what the left graph has. This has the US headline and core inflation, including our projected path that we had put out in July till the end of next year, quarterly path. And the green lines are for the euro area, again, towards the end, going till the end of next year. Two things to note, of course, is that the surprise is a bigger deal in the US, where we've seen very large jumps in headline inflation and in core inflation. I know that there were recent numbers that came out in the euro area for headline inflation, the August numbers. But again, we should expect to see an overshooting of inflation. This is what we should expect to see for a few reasons. One, the so-called base effects, which is the fact that last year prices fell for many sectors, and therefore, relative to that, we should expect to see a jump up. And second, we have supply side disruptions of kind that typically don't accompany a recovery. And we're seeing that in, say, used car prices in the US. So there are transitory features that certainly are driving some of these high inflation numbers. Again, in the euro area, in Germany, the retirement of the VAT cut is another reason that generates a transitory movement in inflation. But again, as you can see from this graph, when I say transitory, I don't mean that we're talking about a month or two. This goes on especially in the US, this goes on into next year. Towards the end of next year, the last data point there is about 2.6% of the fourth quarter. But you're going to have elevated inflation now, and then it goes down. The right graph shows you very important differences between the US and the euro area, where goods price inflation in both places have gone up, but much more sharply in the US. And again, here, there's a very important difference with the used car inflation, the very specific categories that have had very large spikes, and that's part of the story. Also services inflation has gone up more in the US relative to the euro area. And here, again, there are important differences in what we've seen in healthcare price inflation and restaurant inflation. And so there are important differences there. But again, it's hard to think of 2022 as being a year where we will see another 60% increase in commodity prices. It's hard to think of next year as being a year where you would see, again, a 60% increase in used car prices. So again, there are these one-off factors, which are large, that we should expect will unwind. Now, and for the euro area, again, I would like to point out that if you look at our projections for the end of 2024, this is still coming in below the ECB's target of 2%. So these are very different problems in the US versus the euro area. Now, what does that mean, though? Does that mean that we can be sanguine about these movements? I would say, of course, not. There are upside risks, particularly in the US. And the important goal, of course, has to be about anchoring inflation expectations. Now, what do we know from the evidence from the past? That doing this requires, the people believing that the preferences of the policymakers have not changed. So it's very important to signal that you are acting consistently with your mandate. There are, given these highly uncertain times, especially with the pandemic still raging, which means that the supply side effects are lingering longer than anybody expected at the start of this year. This could again trigger movements in inflation expectations. And in such situations, it's important for central banks to move quickly. And we've seen they can do that. In the case of Canada, for instance, they started tapering QE as soon as they saw a change in the data that was coming in. So it's very important to signal that agility to move quickly, of course, to track all these indicators and to credibly communicate what will trigger movements and to then follow through on it and to act on it. So again, it's important to, this is hard-won credibility. And in these times, which again, unique in terms of the recovery, it's important to follow through and to preserve that. Another important feature to keep in mind is that the question of, how much of these policies are beneficial at this point. For instance, QE at the start was clearly very important in settling market dysfunction, but it's becoming increasingly questionable how beneficial it is for reaching any kind of output or inflation targets. And at the same time, we certainly are seeing policies fueling asset prices. Again, that is a natural side effect of when you're keeping interest rates very low. But again, we're looking at very squeezed yields. We're looking at housing prices that have shot up in real terms, which, by the way, also then has spillover effects to inflation as measured in the US, which is, again, why, if you look at my graph for what our inflation projections are, that's part of the reason inflation remains elevated in the first half of 2022 and the middle half. It is because of this possibility that you have this pass-through of the higher prices going into rental inflation. And then the right graph shows you that with markets being in this kind of Goldilocks situation here, that it wouldn't take much in terms of a surprise, unfortunately, to have a financial market disruptions. And one of the scenarios we are very concerned about is, besides obviously having implications for the country itself, the spillover of these kinds of policies to emerging markets, where in an environment where we're seeing the pandemic now hit emerging markets strongly, getting an increase in a financial tightening that causes risk premium to go up will then have a pretty large effect on their economies. Overall effect is estimated to be over $4 trillion cumulatively between now and 2025. So again, this is not applied. Obviously, there's heterogeneity, different emerging markets of different levels of stability and so on. But this is an overall estimate. But again, this is an important concern. Very quickly, I'll just take a minute just to point to a couple of other issues, which is that we have seen improvements in labor markets, but as is typical after most recessions in recoveries, we are seeing a lag in how labor markets recover. And we're seeing differentiation again, which is those who rely, low-skilled workers, younger workers are still facing the brunt of this crisis. Again, there are very important differences between what's happening in the US labor market and the euro area labor market, but I don't have time to go into it. But again, just one has to keep in mind that we are moving towards, again, further automation in many sectors. And that has been one of the reasons for rising inequality. Automation doesn't have to be a bad thing. It doesn't certainly have to be a bad thing. But again, policies have to be managed to make sure that you're not leaving people behind. And then on climate, again, it's very clear from our perspective, you need a carbon price to actually effectively bring down carbon emissions. You need public investment, you need subsidies for R&D, and you need a fair transition so that you are to make sure that the most vulnerable are not affected by it. Right now, if you look at recovery spending, the last estimate that I have says only about 18% of that has gone into low carbon activities. So clearly that has to be stepped up. There's need for a minimum global carbon price to reach the goals. And again, to make sure the hit to education that we've seen is addressed. And I know that this is supposed to be a post-pandemic conference, but the truth of the matter is that this pandemic is not over. And I think the world is really woefully short of doing what it needs to do to end COVID-19, or at least get it to a point where it goes to business as usual, or like somewhat as usual in many parts of the world. And there's a slide here which tells you about the progress made. This is a paper that we did on a pandemic proposal. Progress has been made on some fronts, but there's a lot more that's needed. And I'm going to stop. Thank you.
Thanks very much, Gita, for this comprehensive review of all the important topics of the time. I hope we'll have the time to come back to some of those questions. But first, let me give the floor to Larry Summers. Larry, the floor is yours. You have 15 minutes. Thanks very much.
Thank you. Thank you very much. It's a great privilege to be here with my friends from Bruegel and the international audience they bring. It's a special privilege to be on a panel with my Harvard colleague, Gita Gopinath. I might say the world has been fortunate to have her as the IMF's chief economist during this difficult period, and to join my other colleagues on this panel. I am going to simply argue three propositions in the time that I have. First, where Gita and I are, I'm sure, in complete agreement that the world effort to date with respect to COVID and preparation for future pandemics has been dangerously inadequate with potentially grave economic consequences. Second, to take a substantially more concerned view of the inflation risks than Gita did, and to argue that we are already at the point where credibility demands substantial policy adjustments. And third, about the savings absorption problem, or you might deem it the secular stagnation issue, which I believe may well be the pressing problem in terms of understanding the pre-COVID period, and may well be the principal long-run macroeconomic policy issue in the industrial countries. Here goes. With first, COVID. The world has done a spectacular job of macroeconomic stimulus in the advanced economies. It has done a very good job of vaccinating people in the advanced economies relative to any sensible set of expectations ex ante. It has done a dismal job and is on a path to continuing to do a very poor job with respect to vaccinating people in developing economies and financial support to enable developing economies to function, given the various infirmities associated with COVID, and given the likelihood of a policy turn in the industrial world, which will have serious repercussions for developing countries, looms as a very serious problem. This crisis, depending on how you measure it, has cost the global economy, and will, when it is finished, have cost the global economy $20 trillion. It is madness of the highest order to not suppose that we should be spending 20 basis points of that, $40 billion a year on pandemic response. The same responses, building vaccine capacity, engaging in monitoring and surveillance of populations, developing the capacity for personal protective equipment to be pervasive and so forth, that are necessary to finish the job with respect to COVID, are also necessary to respond to the next pandemic. When one considers that COVID was the end of a sequence that included, or was an element of a sequence that included MERS, Ebola, SARS, N1, H1, it is hard to avoid the conclusion that the risks are very substantial, that within the next decade, there will be another pandemic of entirely separate nature, of consequence common to COVID. It is, I believe, an absolute imperative morally in terms of human security everywhere in the world, and in terms of protecting the global economy, that there be substantially greater investments than we have seen. It was my privilege to co-chair a panel that is advising the G20 on these matters. The precise wisdom of our recommendations is, of course, open to rational and reasonable debate and discussion, and we look forward to it. Our framing of the urgency of the problem, both with respect to the mobilization of further finance and governance, I believe is not open to serious question. And I might just say that I'm very, very grateful for the efforts of Guntram Wolf and his many colleagues at Bruegel, who have played a key advisory role with respect to our panel. Second, inflation. The most important number of the many numbers that Gita presented was her bar graph showing that for the advanced economies as a whole, we are within easy visibility of having output 1% above trend. With output 1% above trend, with supply potential surely diminished by the people who are unable to work, by the people who are unable to shop, by the lack of physical capacity put in place during the COVID year, by the financial strains that have been associated with COVID. What Gita's graph is showing you is that for the advanced economies as a whole, we are looking at a demand-supply gap. A demand-supply gap that has not yet fully emerged, given that we are currently seeing growth at substantially above trend levels, closing the gap. So we know that demand in excess of potential is in prospect. The second thing we know is that policies operate with a lag. I don't know what the latest IMF estimate is. I've always used as a rule of thumb that the lag from response to impact of fiscal and monetary policies is about 1 year on average. I would not argue strongly for the precision of that number. So we know that we currently have a demand-supply gap in prospect. We know that we have policies that operate with a lag. And we know that in the United States, to the maximum extent, but in the industrial world as a whole, the accelerator is on the floor and the car is in the highest gear. We know that with respect to ongoing budget deficits that are close to double-digit levels. We know that with respect to real interest rates that are in the short-term rate averaging below -3 in the industrial world as a whole. We know that with respect to the growth of central bank balance sheets. And we know that that is happening with respect at a moment when there is a huge accumulation of liquidity from the spending that households were unable to do during the COVID period. And so it seems to me that there is every reason to expect that there will be a demand-supply imbalance and accelerating inflation in the future. Gita is, of course, right that there is a substantial transitory element in the measured inflation statistics. Used cars, specific bottlenecks, all of that, there certainly is a transitory element. But what's remarkable is that at a time when 6 or 9 months ago, the IMF was predicting that the world would still be in grave recession, we are seeing such rapid inflation as we are seeing. And so, yes, there will be a coming off of transitory inflation pressures. There will also be an acceleration coming from ever tighter labor markets, coming from employers responding to labor shortages, coming from the fact that house prices are up by more than 20% in the United States, and no abnormal housing inflation has shown up in the official indices yet, but as recent work suggests, the data on house prices presages what's going to happen to rental prices. So this is a substantially more pronounced and pressing issue in the United States than it is in Europe. But I think the crucial point is that for the industrial world as a whole, we have projections of above trend levels of output, reasonable confidence of below trend levels of supply potential, and every policy lever being pushed to the maximum extent. I don't see how looking at that picture and professing a commitment to keeping policy levers at their maximum extent and simply promising to be responsive to inflation can be a good strategy for preserving credibility. And I am very alarmed that the new trend towards woke central banking that is present in many countries is going to be very problematic down the road for our economies. I would highlight as the relevant period and relevant historical precedent the period of the late 1960s, when pressing social pressures combined with a desire to have very strong economies to set in motion substantial inflationary pressures that ultimately had great costs. The third thing I want to address is the longer run challenge. There is a puzzle in the consensus view, and I don't know what the right resolution of that puzzle is, but I would put it this way. After we can reasonably assume that COVID has worked its way through the system in a year like 25 or 2025 or 2026, the consensus view is that we will have reasonable growth in the advanced world, that we will have budget deficits and debt to GDP ratios that by historical standards are extremely high. And we will have real interest rates that by historical standards are extremely low. In the case of the United States, significantly below zero. You might have thought that in economies with very low real interest rates and very large budget deficits, the danger would be overheating. And yet, that is something that is not foreseen. How to understand that? I think that is the question to which macroeconomists should be devoting themselves. One hypothesis is that forward rates are just wrong as predictors of future short rates, that there are a variety of technical factors distorting long-term interest rates downwards. And in fact, that forecast will not materialize. I think that is a real possibility. Another possibility is that there is some wisdom in that market view, that it is a reflection of a judgment that for a whole set of structural reasons, private propensities to save have increased and private propensities to invest have decreased, leading to excess saving, downwards pressure on interest rates, upwards pressure on asset prices. In which case, the broad policy challenge is going to be managing the absorption of saving in a sustainable way, in a sustainable environmental way. Gita was, in my view, completely correct in the emphasis she placed on the climate change problem, but also managing the absorption of that saving in a fiscally sustainable way. But what the market is telling us is that we have that savings absorption problem. Implicitly, it is telling us that the neutral real interest rate in the industrial world, even in the face of very large real interest rates, is going to be significantly negative. And if that's true, that is going to have far-reaching implications for the ways in which we carry on macroeconomics. I have earlier been an advocate of the secular stagnation view. I would not have dared to predict that we would be in a new steady state where we could have deficits of a kind that would push up secular real interest rates by a substantial amount and still have apparent neutral real rates be negative. And I think that's a question that demands attention from macroeconomists. If I might suggest, demands attention, as I'm sure it's received from the IMF. And surely, and I've certainly taken to some extent a parochial American perspective, can benefit from the very great thinking that Bruegel has provided on European and global issues for many years. Thank you very much.
Thanks very much to both of you for those introductory speeches. Let's now turn to the second part of our session with a discussion with our four speakers as well as with our audience on Slido. So please ask questions on Slido. I see that a few questions are already coming in. But before taking questions on Slido, I would like to give Per and Jorge the occasion to react to what was just said. And first, let me give the floor to Per. Per, what's your view on the inflation outlook? And in particular, I would like you to draw on the experience of your own country, on Denmark, because Denmark has been reopening more quickly than, let's say, the euro area. And at the same time, the inflation outlook in Denmark is still very much subdued. Inflation is below 2%, core is at like 1.3 or something. So inflation there is not an issue yet. And at the same time, I noticed that in one of the slides from Gita, where there was housing prices, and we saw housing prices, the one on the top, it was difficult to read, but the one on the top, I recognized it was Denmark. So housing prices have been going up by more than 15% in Denmark. So do we have a new form of inflation in Denmark where asset prices are going up, in particular housing prices, where maybe excess savings collected during COVID were used in the housing market?
Yeah, Thanks for these questions. I would hate to spend too much time on my own country, given the weight in the world economy. It has some interest, given the stage we are in, but let me come back to that later. You asked the question easily in writing, is this a blip or a permanent shift? I would argue it's neither. It cannot be a blip because the forces we are observing, the shift from some sectors to others, the bust followed by a boom, fiscal policy, which is hard to interpret, how much is compensation, how much is underlying stimulus, which would carry over to the following years. These forces are very strong. On the other hand, central banks are not going to default on the inflation mandate, so in the longer or medium term, inflation will be contained. So the issue is really what happens in between. Basically, this is not healthy, and I'm not talking about the origin of this crisis, I'm talking about the economy. This is not a healthy situation, and we should observe that inflation or not, there might also be non-inflationary distortions, costs such as waiting lists, components, the absence of components for companies, which might lead to pressure on productivity. And it might be more difficult to observe in the short run, but we should take care of that as well. So where are we now? Well, the headline numbers have certainly been shooting up. We have all seen all these price components, shortages of labor in many places. On the other hand, the forward-looking indicators are surprisingly downbeat. Inflationary expectations have not shot up. Interest rates are surprisingly low. Salary increases have not really given in yet, and if we should see some more permanent inflationary pressures, salaries will sooner or later have to kick in. I would say the most likely outcome is leaning towards what Larry is explaining. This is a highly inflationary case. It's given a long period of history, this is going to trigger inflation and spilling over also to underlying issues. However, looking at the last decades, we have been surprised on the downside quite a few times. It was a very well-balanced recovery, and we managed to get unemployment very strongly down, especially compared to the past. It might surprise on the upside. And there is an upside. At least in Europe, I think. This might be a chance to move to a better aligned environment of inflation and interest rates, if we are lucky. I wouldn't give it too high odds. I think the disturbances we're seeing are very high. But there is such an upside and less of a risk of overshooting as if we compare to the US. Briefly on my own country, we are very advanced in the cycle. House prices have been shooting up. Employment is now higher than it was ahead of the crisis. GDP is not completely back, but will soon be. And there are widespread labor shortages. But still, wage increases have not kicked in. And the discussion is how much of this is temporary, how much is permanent. I think it may be a bit more permanent than people believe. And the reason is what we see in terms of wealth increases, a combination of house price increases, stock market increases, pent-up demand from the savings involuntary undertaken over the last year or so is making wealth improvements particularly large. That's not going to be completely temporary. Finally, just two questions, which I'm a bit concerned about. The one is, if this is more protected, it might require high interest rates to beat inflationary developments. How well prepared are we for that? Households, non-financial companies, the financial sector, not least the public sector, for a shift in the interest rate environment. That's quite important. Second, what does this mean in terms of transition or not to combat or extend the risk of secular stagnation? There has been a tremendous focus on debt, be that public or private, in the past. In my view, much less attention has been paid to the opposite side of that debt. Who are holding the financial assets? Who are they? Are they pension funds, rich Americans, sovereign wealth funds, Japanese companies, German companies, or whatever? It needs to be mapped out better, not least to try to get a better understanding what to do about the underlying problem, because the alternative might be that we have to feed public debt more or less forever to absorb these private savings glut, and that is a bit unworrying for somebody who used to work in the finance ministry.
Thank you very much. Per, I want maybe you to zoom in on the euro area, because I also remember in one of Gita's slides where you could see the trend. You could see that the US was going above trend, as Larry noticed. But in Europe, it's not the same. Even until the end of the forecast in 2022, we could see that Europe was still below the trend, the pre-crisis trend. So what do you think is going on in Europe? And where do you see inflation in Europe? Do you think it's such a problem as the ones that Larry noticed in the US, or are we in a totally different situation than the US?
First of all, thank you for the invitation to be here. I'm very glad to be in this panel. I guess the overall picture is broadly the same in both countries in terms of direction, but is radically different in terms of timing and in terms of the policy impulse that has been plugged in the economies. I mean, just take fiscal policy. The output loss in the US in 2020 has been matched by more than 3 times by the fiscal stimulus that is concentrated in basically 2 years. While in Europe, the GDP loss in 2020 has been equally matched 1 time by the NGU over a longer horizon of time. So although you might, eventually those have helped in terms of bringing up activity, the impulse has been much larger in the US than in Europe. Also, the starting point was different. The inflation levels in the US were significantly larger than in Europe over the past 10 years, and they have been significantly below the objective of the central bank. So let me put some numbers into this. Just running some simulations, even taking forecasts of different people, letting the models go free, running simulations on core inflation over the next 2 years, we get a similar conclusion than the one Gita was pointing, and is that it is very difficult that inflation goes below, core inflation, below 2.5% in the US in the next 2 years. It is very difficult that core inflation goes above 2% over the next 2 years. Even when you kind of push a little bit in the Phillips curve framework, playing with fiscal stimulus, playing with a little bit with inflation expectations being adaptative so they can go up a little bit given that inflation goes up, and also playing on the fiscal multiplier, we don't get a significant change in the outlook for inflation in Europe. We do get it in the US, but not yet in Europe. So I guess that the question boils down to what could change that picture. I mean, you can have non-linearities that can kick in, and we never know how this is going to go. Again, to put some numbers into this picture, if we take a Phillips curve in the US and Europe, and we use the sensitivity of the output gap in the 1990s, to the output gap in the 1990s, which was larger than today, we get a forecast of inflation, core inflation, 2 percentage points higher than this 2.5 in that horizon, and only 1 percentage point higher in Europe. So the risks are significantly lower in Europe, and although I guess we all should be moving to bringing down the risk of needing to act too late, because it will be politically costly, and this is being done, I think it will come significantly sooner for the US than Europe.
Thanks very much. I'm wondering if we have lost Larry. I know he was supposed to leave earlier, so I guess we will not have the occasion to come back to him. But before I take questions from Slido, let me ask a question directly to Gita, because I want to come back to that graph where the trend, where the US goes above trend while Europe goes below trend. Do you think, and what does the IMF think about fiscal policy in Europe? Is fiscal policy in Europe still not aggressive enough to come back to the pre-crisis trend, or do you think it is adequate given the situation? It has been a bit smaller, the deficit and the increase in the deficit in Europe has been smaller, but people in Europe have been saying that compared to the US, it's because it was more targeted and more efficient. Is it something, a view that you share, or do you think Europe should have done more or should do more still in 2021 and 22?
So firstly, let me just make sure everybody understands what that graph says. It says that for the US, you certainly have the US in 2025 significantly above the pre-crisis trend, but that doesn't mean that's a situation where it's a very large positive output gap, or it doesn't mean the demand is much higher than supply. There's also been in that forecast, under the assumption that you have the additional infrastructure investment, both the physical and the social and human capital related investment that's in the packages, then you also get a boost to potential output, right? So you shouldn't read this as an overheating signal necessarily, but also a move in potential output. In terms of the comparison, firstly, comparison is difficult to make because there's the use of reliance on automatic stabilizers is much more bigger in the euro area. So when we look at additional stimulus specific to this COVID, it tends to look bigger in the US, but that again is a matter of measurement. And of course, how quickly countries recover and how they close the gap depends a lot on sectoral compositions, how their reliance on tourism. It depends upon the kind of labor markets they have, the reliance on informality of the contracts, and so on. And so it's not a one story fits all. So to your simple question of should Europe be doing more, I think Europe has done a substantial amount. The Next Generation EU funds are a great way to both raise potential output and through that also raise output in general. And like you said, it comes in over a few years, but as long as that money is well spent on investment, green, sustainable, digital investment, all of those features, then I think, it is on a very good path.
Thanks. Let me take questions from Slido. So the question that is the most popular at the moment on Slido is actually a question from one of my colleagues from Bruegel, Maria Demertis, who is in the room and is asking a question on Slido. And her question is, the ECB owns a large share of euro area country bonds. This makes monetary policy a lot more like fiscal policy. Does this increase systemic vulnerabilities? Who wants to take that answer? That question, sorry. I don't know.
I'm not supposed to interpret the reactions of the
Okay,
ECB,
so you have a good excuse not. So
to
maybe Jorge, you want to take that question.
I can take a shot. So this is going to become a tool of policymaking in the future, especially in this world in which, as Larry Summers was commenting, there are chances, significant chances, that R star is very low. So in this context, we're going to be significantly closer to the lower bound more frequently than before, and we're going to need to use additional policy tools that have already been set in the framework of the monetary policy revisions that have been undertaken by the ECB and the Federal Reserve. Now, so in a sense, this has to be done in a context where you want to make sure that the financing conditions are such that are applied more or less homogeneously across different countries. So it's a combination of QE and bringing risk premia down. Now, there is one concern there. I mean, take the US. If you take the net issuance of the US over the last year, the Fed has basically bought half of it, right? While the other half has been taken up by the market. While in the euro area, and especially for peripheral countries, the ECB has bought the whole issuance of the peripheral countries, and in some of those countries, I think it was Greece and it was also Italy, they have even compensated for the decline in foreign investors, right? So the vulnerabilities that might arise whenever the monetary policy normalizes are likely to be higher in Europe than in the US, and in this regard, it's very important to have a very credible path of fiscal consolidation down the road and structural reforms that reduce that risk. So. Yeah.
Thanks. Gita, I would also like to have your view on this, and if I say it in a blunter way, do you fear that we are on a slippery slope, that basically that this threaten central bank independence, and that we are seeing some monetary financing when asset purchases are above net issuances, as one of your graphs showed in your presentation?
So again, to call something monetary financing, I think it ultimately comes down to whether it is financing that's being done by the central bank at the behest of fiscal authority. So, is it violating the mandate of the central bank? You can call it in different ways, QE, helicopter money, so on. Ultimately, whether it is monetary financing or not is a question of whether the central bank is doing this to meet its own mandate, as opposed to being pressured by the fiscal authorities to do it. And so we've seen balance sheets grow dramatically, as the person who asked the question said. We've seen it grew substantially right after the GFC, and it's gotten a big bump up again after with this crisis. But if you look at what the implication of that increase in the balance sheet of the central bank has been on inflation expectations, so far you would be really hard pressed to find anything, right? So that would be consistent with living in a world where R star is very low, you're very close to zero lower bound. And again, as long as you have central bank independence, central bank credibility, you cannot see this big any kind of a shift. Whenever you have these large unconventional monetary policy announcements, you are not seeing any kind of a de-anchoring of inflation expectations, right? And again, there's always the case of Japan, where compared to Japan, the balance sheets of the US and Europe are still small. We've had really large amounts of fiscal spending, large amounts of monetary expansion, and still the struggle is that they're still dealing with negative inflation and deflation. So again, the structural factors are very important. And as long as monetary policy is being driven by the goals it has set and not being influenced by the fear of raising interest rates, and that would then have an effect on debt. So far, we live in that paradigm, and that paradigm has served countries well. So I think maintaining that is essential.
Thanks. I see that Larry actually is back, so thanks for coming back. And actually it's great because I wanted to ask you a question about secular stagnation. And I wanted to ask you if you think that the main ingredients of secular stagnation are still there, because you seem to imply that in the long run you still see them being there. But actually now we have more aggressive fiscal policy. And this morning in another session we discussed the need for a lot of investment, public and private investment, for decarbonization. And actually, as you said, one of the ingredients of secular stagnation in the way you formulated it is the lack of investment. But we need a lot of investment if we want to reach our climate target. So maybe, do you see the main ingredient of secular stagnation maybe disappearing because of the fight against climate change? Or am I too optimistic?
Look, I think you can think of secular stagnation as representing an opportunity. There's a huge quantity of resources that households and businesses want to put aside and invest for the future. The private sector can make normal investments and prepare well for the future and do essentially all the opportunities that have positive productivity with less resources than are being put aside for the future. That's what an excess supply of savings means. So it creates a great opportunity for meeting other kinds of needs, whether those are green needs, whether those are COVID-related needs, whether those are needs related to making more just economies. So if you think about it, and a natural excess of savings is a great opportunity. Will that opportunity be taken advantage of? Not automatically. We know that when there are investments that have low private returns, but high social returns, privately motivated actors will not fully undertake them. And so the question is, will we find a combination of regulatory policies, inducements, changes in corporate objective functions that cause there to be a substantial increase in these investments? And I very much hope that the answer is yes. Secular stagnation is potentially a backdrop because of the lower borrowing costs fundamentally that makes green investment to address climate change more attractive and more fundamentally important. In all honesty, do I currently see policy frameworks that have been agreed politically and that are in place that will drive the 3 to 4% of GDP globally in green investment that would be necessary to close the savings investment gap? I can't honestly say that I see political frameworks that are driving things of anything like that magnitude. I've been very excited by the initiative that Gita's boss, Kristalina Georgieva, has taken at the IMF. I've been excited by the various proposals to create resilience funds and the like with SDRs, to use them to make contributions to global climate change. But let's understand it ourselves. The numbers we're talking about are at most in the 10 basis points of global GDP range. So we've got, maybe I've missed something there, and maybe it's a bit greater than that. But if you believe we have a savings investment gap that's measured in the percents of GDP of advanced economies' GDP of $50 trillion, we're going to need lots more, even allowing for catalytic elements, if green is going to be a substantial part of the solution to that. But very much the opportunity is there.
Actually, I want to take a question that is a bit related, because you say green may not be enough, but maybe also digitalization and automation, investment in those could be important. And there is a question that I got on Slido from Jan Mischke, who says, our research suggests that productivity growth could accelerate by 1 percentage point from faster digitalization and more. How much would that alter projection and risk? Because it's true that if we have a lot of productivity, in the end, maybe it will change also our inflation outlook because it will raise potential growth. Who wants to react on that, on the impact of COVID on the rise of productivity?
I'll take a quick crack at that before I have to leave, and then you'll get a more thoughtful answer from Gita. I'm skeptical. There certainly are going to be gains. Bruegel wouldn't have been able to organize a conference at a distance, a hybrid virtual in present, as well as it's doing right now 2 years ago. And those kinds of things are a positive impact. How large that is, I think, remains to be seen. What I see in the United States is all kinds of measured productivity increase that I think is very likely to be transitory. I have eaten at some number of restaurants where measured productivity would be very high because usually the restaurant has 6 waiters, but they can only find 3. And therefore the 3 waiters are running ragged, trying to take care of the usual number of customers. So in the short run, it's terrific for the people who own the restaurant. They're making a lot of profits. Output per worker of that restaurant has never been higher, but those waiters are running ragged and they're going to quit unless they get help or very big raises. And I think we're seeing a lot of that phenomenon in the productivity statistic in many different places. And so I think we should be very cautious about extrapolating from what we have seen. Look, I think that those of us on the progressive side have to be rather careful. Progressives tend to be fond of arguing during difficult times. There are hysteresis effects that are going to reduce potential in the future, hold down because of the recession or downturn or whatever it is, future potential. And then when we get to the future, they tend to forget those arguments and assume that there's great capacity to increase potential. I'm not sure at all that the positive impacts won't be smaller than the negative impacts of what we've been through. Thank you very, very much for the opportunity to have been with you, and I'll look forward to getting a report on the remainder of the discussion that I missed. Thank you.
Thanks very much. I see actually that we only have like 2 minutes left in our time. May someone who wants to have one last word on productivity or on anything else? Gita, Jorge first? Yeah, okay. Or Gita, you wanted to have a last word?
No, I'm happy for Jorge to come in.
So I would say that one of the main problems that we had before this crisis was related to productivity, and not many things beyond COVID have changed. But if I want to end with striking a positive note, because I overall agree with what Larry said, I think we could on 2 grounds. One is that if you think how general purpose technologies work, it's a combination of things what eventually bring up productivity. So we have had big data, machine learning, automation, and perhaps what we're lacking is the organization of work and education. And those 2 things in some places might have changed because of COVID in some places. So maybe it's a step ahead that we needed in order to make sure that those general purpose technologies go into higher productivity. And the second positive note is if we manage to do the climate change transition right in such a way that, as many others have said, generate an increase in productive investment. But there are reasons to be worried in terms of whether those are going to dominate the downside forces.
Per, any last word?
Just a warning that it's very difficult to extract or extend a long-term projection on productivity based on a standalone technology as that. People did that mistake in the past as well. Productivity developments depends on a tremendous amount of different things, including a shift between sectors, including a shift from goods to services, which is a much larger part of the economy than it used to be. There are some upsides from some of the developments we have seen, but a little bit skeptical about that suddenly something happens which enforces the use of a certain technology which nobody ahead of that had discovered that it would actually be very productive. There would be some productivity losses on the other end. Too little physical contact is also a problem for exchange of ideas, inspiration, creativity, all that. And we need to come back to that. We may survive this in the short term, but we need also to come back to a bit more normal life. Just as an example, it's a privilege here to be on stage. It's the only way in this building you can drop your face mask. It may be the only place in this country where you can drop the face mask. So you should try it.
Gita, no final word?
Well, I guess I will make 3 very short points on the productivity issue, which is, one, it's too early to say whether we're looking at any kind of a trend. There are reasons, and I agree with Jorge on this, there are reasons that it could come up, it could be good news, but it's too early. Second, if you look at market-based measures of what growth rates are going to be 3 or 4 years from now, and related to the R-star, there's nothing there that right now points to an expectation that number is going to be significantly higher. And 3, that while productivity growth will be wonderful, it's something we're all waiting for, there is the risk of this being a labor-saving productivity growth as we have greater automation. And of course, that doesn't mean to kind of not do productivity investments. But again, that is a challenge the countries will have to deal with.
Thanks very much. So wise conclusions that we need to wait, that it's too early to conclude. I guess we'll have to invite you again in a few years to discuss about inflation and productivity after COVID, if COVID finally ends. We could continue this conversation for hours, but unfortunately we're already over time. So I want to really thank you very much, our 4 speakers, for participating. It was really great to have you. And it's unfortunate that we cannot have you for longer, but I hope we'll see you again very soon in person. So we need to put an end. Thank you very much. And we'll come back, I think in 15 minutes, there is another session on the future of work. So if you're interested in productivity, you can come back in 15 minutes to discuss the future of work with our next panel. Thanks very much, and see you soon, I hope.